Nate Smith, CEO of Hauska, and Porter Stowell for the Filecoin Foundation. Welcome. Matt, over to you.
Yes, welcome guys. So hopefully with this panel, you get also a better view on what digital assets can do for the real estate environment. So we have 3 creators of digital assets and 1 creator of the digital infrastructure. Okay, these digital assets hold data. This data needs to be stored, and there are a new infrastructure that is being built to store that, and that's the Filecoin network. We want to recognize also that they are a sponsor of the event. Natalia from Propi, Darren from Triangle, and Nick from Oscar. So I will start maybe with Natalia. Natalia, you've been a pioneer for blockchain for real estate, tokenization, creating digital assets with real estate properties, transforming ownership on-chain. Can you give us a little more info about what you do, what is Propi, and what you do in real estate?
Absolutely. Thank you so much for having me. What a great venue, especially for demos. Enjoyed your demo as well. Yeah, it's a fascinating space now, Web3, which is the new internet of moving assets, digital assets. And I think probably what we've built is very easy to comprehend. When you can buy an entire asset of real estate entirely on-chain. And we've been a pioneer in transferring ownership of real estate just with a couple of clicks between 2 wallets. So you can connect a wallet, click consent to become a homeowner of a particular property, real physical property, not a digital twin in metaverse. Transfer your Bitcoin, USDC, Ethereum. Recently we actually gave a loan against Bitcoin and have this property entirely transferred on-chain. We've been building this technology for 7 years. We do also traditional title and escrow services, again, with smart contracts, utilizing AI for document processing. We've been backed by Team Draper. We work with a number of real estate developers, leading realtors here in Florida and other states. And it's been a fascinating journey on transferring physical assets, which is real estate, which I believe behaves as a digital asset. Because we don't move walls, we move ownership, we move data, and that's why it's fascinating to be here today.
Right. Can you explain a little bit more on how you can transfer ownership of a property, knowing that usually the title needs to be checked by a title agent and to clear it before? And so how can you move from the traditional world to the on-chain world and move the property of an asset? What's the process?
Yeah, that's a great question. So we have 2 business models. One is traditional title and escrow, so we have a license, and we do all the traditional 30-day closing. We can shrink into 7 days, but we do it kind of like checking the title and doing the transferring dollars, working with bank, but we're integrated with banking system. We're integrated with all the counties, with the majority of counties in the United States. So in this arena, we've been successful, profitable, onboarding realtors. I see a lot of clients here as well. Thank you for your support today. So this title and escrow industry, which we want to disrupt with being within the industry, we use, again, smart contracts and AI. But the other one, the second one, that's a true innovation. That's what you're asking about. So in the second one, we do all the on-chainization in advance. So we check the title in advance. We check the property in advance. We build comparable analysis, price analysis. We collect as much data as we can. Hopefully, with your help soon, we'll also incorporate your data assets to this business model. And we also create a trust or an LLC in advance before the sale investment. And so once we create the LLC or the trust, then the ownership is transferred only via a token, a blockchain token, which allows now the new owner to come and verify and read all the document. The inspections are there, all the data is there, title is clean. Now you can connect your wallet and acquire this asset. One caveat, we have to do KYC and AML.
Yeah.
So we're compliant with real estate laws. It's not a security, luckily, because we don't do
Yeah, so
fractional
explain that the difference between a security and what you have, because lots of solutions for tokenizing real estate are about creating a fraction of ownership of a piece of assets and distribute it to many token holders, and oftentimes it makes it a security. People invest in an asset for growth. When you're selling a home or a house, is that a security?
When you sell or buy an entire home as a token, it's not a security.
Right.
Otherwise, when we sell and buy real estate, it would be a security, but it's not, and then realtors would have to have a broker-dealer license and so on. So once it's one property and you're selling it to a couple or one buyer, it's not a security. Now, if you're selling it to many people, then it gets into the security laws. But the fractional ownership and tokenizing real estate in terms of fractions represented by tokens, it's also a fascinating technology. And I saw one of the founders here of one of the platforms that is doing fractional ownership. It's fascinating and it's absolutely legal. So utility tokens and security tokens, the securities are more clarified today. There is less uncertainty in security tokens. So you buy a fraction of an LLC or an entity that owns the whole building. And the main thing is that the liquidity has to be on a security exchange. That's all. So it's pretty simple to understand both utility tokens and security tokens. And I believe from your demo, you'll be incentivizing the crowd to bring the data with the utility tokens. This is where we're waiting from the new administration, which I'm very excited about, to clarify what is a utility token.
Right.
I got a question.
Yes.
Because I'm fascinated by this topic. When you look at the title, where is the single version of the truth when it comes to the title? Because you're doing your own title check and you put it on your own chain. But is it the city or the county, do they have the single version of the truth? Or are you kind of getting to a future state where your blockchain-based record and title that's clean is becoming the version of the truth?
I think you will like my answer very much, being from Filecoin. So when I explain, we have two business models. One is the traditional title and escrow. So when we transfer the ownership, we record in the county. We have the copy of the deed that has a QR code of the Ethereum address on it. And then we also store this file on Filecoin.
How did we not know this? Like, we're just meeting today.
You should, we're partners. So we really like the decentralized storage system. Why? Because there are 3,000 counties in the country, and often they get hacked, they get ransom attacks and whatnot. So the final truth has to, at least the copy of it, has to be on a decentralized storage. So that's why we're doing it for now in parallel in this business model. But I believe with the new administration and what Doge is talking about, there are a lot of conversations about bringing infrastructure to decentralized systems. So I think this will become the standard now. With the second model, with the second model, we actually record one time in the county this record as an LLC, and after that we don't come back to the county. We just transfer the ownership as the name. We change the name in the LLC agreement via our digital infrastructure. So the final truth is that the LLC is recorded in the county, but then we change the ownership entirely on chain.
Right. And if, I guess, the property can be updated, the state of the asset, the liens on the property, the mortgage status can be updated on chain, then the entire property can live on chain. And therefore, the title can be transferred directly on chain. You won't need to have the traditional system anymore. That's, to your question earlier, that's how we move to that mass adoption, that properties will live on chain.
Yeah, I have a lot to say about the liens and the mortgage, but I don't want to overtake the panel, so maybe the next question.
We'll go, yeah, we will touch after also on something that you recently did, which is collateralizing digital assets to buy real estate properties. So that's also very important. We will touch on it after. But thank you. So you understand that that's one digital asset that you can create with the ownership of the properties. But there are other digital assets that you can create with using the data. One of them, Darren, you run Triangle. Triangle is a platform that it's a Web3 carbon system, carbon emission tracking, right? That you allow to create digital credits with the carbon emission that you can transfer. Another digital asset. So Darren, can you tell us a little bit more?
Yeah. So Darren Wolfberg, co-founder, CEO of Triangle. We've built a carbon finance platform, and that platform has 3 modules. The first module is your accounting, so your greenhouse gas monitoring and reporting. To get into the weeds of it, scopes 1, 2, and 3. Scopes 1 and 2, anything that happens in your buildings, in the walls of your organization. Scope 3, anything upstream or downstream from you, and that's more for transparency and information transfer. The second module is a sustainability-linked lending and digital twin platform. So banks, asset managers, they invest in assets like digesters or solar or wind or battery or EV. The data from those assets in the field flow back into the portfolio for risk management, so you can see real-time operating, economic, climate, and insurance information. That information from the field links to the third module, which is a carbon credit and renewable energy credit minting system, all on Web3, delivering the auditability and verifiability of the underlying data, the calculations, in order to substantiate this asset. And so we do that all on Web3. We became one of the first broker-dealers globally permitted to issue and sell digital assets, so very much as you talk about property and title movement, moving into the securities and the commodities world and institutional finance. We think that this is a major asset class in the making.
So how do you characterize this digital asset? Like, is it a security that you're selling? You're creating security with carbon credits?
So a carbon credit is technically a commodity. It's known as an intangible asset. It's regulated by the CFTC. Now, much like the digital asset market that I think we're all kind of waiting and hoping for a transition, this is a spot asset, spot market asset, as opposed to a future or a derivative. Today, the CFTC does not have oversight over the spot market, and that's one of the regulatory changes that's being sought in this evolution. And so, by having this asset as a regulated financial instrument, it now means it's no longer a stranded asset. And so today, these assets are created by registries, and these registries are not regulated entities. They're not performing AML KYC. And so they're acting as the creator of the asset and then the custodian of the asset. And so as the custodian of the asset, meaning the holder of the asset, they're not qualified custodians. They're not banks. And so they're unable to provide you collateral, lending, create structured products off these assets. And so by this asset class becoming a regulated financial instrument, now banks can get into the business of providing you collateral on these assets. And so therefore it becomes part of the value stream of your loan.
Right. Can you explain a little bit more on that? So how can a company capitalize on that? That means get carbon emission tracking, create the carbon credit, and then use this as collateral to finance their business, for example.
Absolutely. So here's an example. We're working with an organization that is taking manure and biomass waste from agriculture. They go into what's called a digester, and it's basically a high heat ecosystem that breaks down all of the materials. And so the output of this is renewable natural gas. And because the manure is not releasing methane into the atmosphere, the biomass is not being burned, what we're able to do is now create carbon credits from this activity, and that's based on data. That is the amount of feedstock that goes in, And so you have what would be your emissions if nothing occurred versus something occurred, and what are your emissions, and the delta between those two is your carbon credit. And so S&P Global, which is a world-renowned ratings agency, they use price targets of carbon credits when they're running their credit ratings on organizations. And so their price targets for these assets to maintain 1.5 degrees, which is kind of the global standard of the Paris Accord. 1.5 degrees for 2025 is $395 going to $900 2030, $2,000 2040, $3,200 2050. And so using independent numbers, that gives you a sense of where these assets can go to from a price perspective. And today, they're much lower. So we believe, and many other asset managers, much like Bitcoin, which was $100. When there was $1 billion traded annually for Bitcoin, Bitcoin was $88, and so now it's $100,000. That's essentially the wall of worry of regulatory adoption and institutionalization of the asset class. And so same thing that we're seeing here today, and carbon credits just back in 2012 for Bitcoin. That is kind of where we are as a moment in time for carbon credits.
What's the volume traded on carbon credits right now?
Today it's about $1 billion a year is the volume. But what you have is 80% of global GDP now has regulatory reporting requirements on carbon.
Right.
And so you're in London, you can't get a loan on an old building that has bad carbon emissions.
Right.
And so people are able to buy carbon credits in order to increase the longevity of that asset. Potentially as part of the closing process, you have title insurance and what's the price of that, and other closing costs, and then you might have a carbon cost, and that is to extend the life of that asset.
Right. What's the forecast on the market?
So at S&P Global for next year is $395. Some of these trade in the $10 range.
Okay.
And then that goes to $900 in 2030, $2,000 2040, $3,200 2050.
Oh, very interesting. So you see two examples of digital assets created through data. Data that has been collected, proven, packaged into a digital asset that you can use as collateral or sell. Thank you. Nick, I'm going to give it over to you. So you are by trade in construction, real estate, general contractor. You decided to create OSCA, which is a company that creates digital assets with designs for architecture, engineering, and construction. Another type of digital asset. Can you explain a little bit about that?
Sure, I'll correct you just a little bit. So we don't create digital assets. What we do is we give design professionals the opportunity to monetize their IP.
Yes.
And so we give them the tools to.
Is the mic on? Is the mic?
Is it on? That's out there. Okay. Okay. So we give design professionals a way to share, exchange, and monetize their intellectual property. And so really, two of the questions that came up in the crowd we addressed, which is one, how do you not create another Silicon Valley where there's just a powerful few and everyone else gets screwed? And then two, how do you drive adoption? And so we focus on we meet people where they are. You will never get contractors and architects and engineers to switch drafting platforms. That is simply not going to happen. They are stuck in the mud, and because that's what they know. That's what they're comfortable with. That's how they make their money. But if you provide a way to make their life better by giving them their time back and more money instantaneously, then they're willing to engage in the ecosystem.
Can you give us an example of what are intellectual property, for example, this chair or a door frame, or what is it that you...
Absolutely. Everything you see in a built environment has a digital file backing it.
Right, digital model. Like we said, it can be part of a digital twin. Right?
Exactly.
Okay.
Exactly. But there's still, again, this is Web 2.5, right? We have to bring up everybody to a full Web3 ecosystem.
Yeah.
And so we just have to be able to capture that data. And so here's an example of a use case leading all the way up to a digital twin. as an architect, I'm going to design a house or building or whatever. And if you use house with ecosystem, you pull all your files, your collected files from your peers, so it's a peer-to-peer network.
Yes.
Okay? So if I need a chair and a gentleman in Belgium has that chair, instead of designing that, it's an IP exchange.
Right.
I reach out,
Yes.
I purchase it from him, that is verified by a smart contract in what we call verified digital assets. And that is basically an NFT, but it's not a collectible, it's a utility document.
Right.
Okay? So as I build a plan, it's a collection of all these files. We do our thing, we get all the way through, ready for construction, and now you have a digital twin, which is kind of like a twin-ish, right? It's
Yeah.
a 2.5, but you know who did what, where the IP came from, what the warranty information is on it, all the way before pre-construction.
Correct. I compare it to an Napster for intellectual property between architects or engineers, where imagine there you have a network where you can share designs and some other architect can benefit from what you've done if it's been proven and buy pretty much your design, right?
Exactly, and it's just little pieces of exchange, because, you know, as we talk about data as an asset, in the AEC, the architecture, engineering, and construction industry, there are millions of pieces of data being exchanged every day. And so you give the people the power to monetize those, and now it's a smaller piece of every transaction.
Right.
The business model is really going to change. And then once you have adoption on the level that you can just meet people where they are, now you can start introducing more smarter assets so you can build a digital twin from the start, right? But it's going to be a long time coming for that. But the point is to have an ecosystem where they can draw files from, and slowly over time you'll get to where the standard is to build a digital twin right from day one.
Right, right. And that takes us also to the amount of data that is generated by these digital models. And it also comes with a new way to store data. And Filecoin, that's what Porter does to represent the Filecoin Foundation, which is a decentralized storage, as opposed to a centralized storage, which is, I think, a big part of our storage today. But you represent Filecoin, which is, I think, the largest decentralized storage solution in the world. Can you explain a little bit how that differs from centralized storage?
Sure. So when you look at the centralized storage options, many of you familiar, this is your Googles, your Amazons, your Azure platforms, and these are centralized services that make business easy to do. And most people don't really care about data storage, they just want it done. But you know, we've heard about title insurance and creating a digital asset or token of your actual property. We've heard about carbon credits, we've heard about architectural designs. But really, what each of these solutions have in common is that they're trying to provide trustless information exchange. And one of my favorite sayings in all of Web3 is, don't trust, verify. And the centralized system, whether it's how you store your data or how you work with Amazon or how you work with this legacy status quo processes, is you have to trust someone at some point.
Yes.
And we're trying to put that to a place where all these participants, my panelists, are trying to say, don't trust, verify. It's on chain. Go to the record, whether it's carbon credits or your actual, the title for your house or your architectural designs. And what Filecoin comes in and does is it provides that quality assurance mechanism so they can back that claim. Because again, you're trying to portray an element of trust to all your stakeholders on chain at all times, and that is verifiable. So what Filecoin does is we have one of the only verifiable storage solutions on chain globally. So what does that mean? Every 6 to 8 hours, you will get a proof that your data is stored where you left it in the state that you stored it in, and you get that every 6 hours. That's verifiability. So if I'm trying to prove to someone that, hey, your title is exactly in the position it was when you uploaded it with us via Propi, I have proofs every 6 hours that will prove to anyone involved in that transaction that that title has not been tampered with because it's stored on Filecoin. So it becomes a quality assurance mechanism in a trustless environment that allows the more frictionless execution of all the things these panels are doing. And I love panels for the simple reason where I could use them to like educate myself. I'm truly honored to be with such like intelligent and inspiring entrepreneurs. So I got to take this opportunity. Darren, I loved hearing about Triangle, and I couldn't help but sit here and think that what you were planning to do with buildings should negate. I wouldn't say negate. Negate's not the right word, but disrupt what LEED certification is doing in buildings. And I just would love to hear your perspective on that.
Yeah, so I think that we're in this moment of transition. And so the dollar numbers, because I think the dollars are going to be the mechanism of this transition. $50 billion was in sustainability linked in 2018. End of last year, $4 trillion. By the end of 2026, $34 trillion per PwC, $160 trillion by 2030. And so I view that, I have 20 years institutional finance, I've seen moments in time where things weren't a thing, and then they were a thing. And so AML KYC was one of those things. Dodd-Frank was one of those things. And so this is one of those things. And so in fixed income markets, high demand, high price, low yield, low demand, low price, high yield. And so this is all about the flow of money. And the flow of money into compliance is a tidal wave. And so the cost of borrowing differential between compliance and non-compliance, we're already starting to see a spread. And so because 78.9% of the top 200 investors globally have these compliance reporting requirements, which means that they don't comply, they're going to be managing less money, which means they make less money, which is something that they don't like to do. Okay? And so because of this wall of demand of capital, we're already starting to see a spread differential in the cost of borrowing. So for AAA debt, the best debt that's out there, 76 basis points. When you move to triple B, it's 1.8%. When you move to triple C, it's 6%. And that's just about capital flows. This is markets expressing themselves on risk. And so those that are compliant are going to have a lower cost of borrowing. Those that are not compliant are going to have a higher cost of borrowing. And so what we do is we link the data to assets, so therefore you're able to have that auditability and verifiability.
Right, so there is a premium to transparency. In the new economy that's coming, transparency is key. And to have transferability of asset, liquidity in the market, we need these tools.
Right. Yeah, and I love that statement, Darren, because I think for everyone in this room, that's a real opportunity. No one cares how much the tech is going to cost you if it shaves 75 basis points off your, $100 million loan. That's right. Full stop. That's right. And again, when you have on-chain verifiability, the amount of time and effort it takes to prove that you are compliant with the regulatory standards goes down significantly. We're talking, 90% X. And again, it becomes about a capital efficiency story, and that you're actually, it's not technology, and we're selling tools and services. It's allowing you to sit at the biggest table in the biggest markets and show real value and differentiation. And that's what I love about everyone's stories here, is you're sitting at the biggest table in the biggest markets and providing a differentiating, disruptive story. And my goal for Filecoin is just, how do I help companies like this be successful and contribute diverse that don't trust, verify on-chain with data storage?
All right, awesome. And we touch after on also the amount of data compute that is needed, and we'll see with Holland and the next panel how also the storage is going to be different, and how we can compute this data with decentralized network much faster and much more efficient way. Natalia, I would like maybe to touch again on your recent transaction and what you did with the collateral, and as putting Bitcoin as collateral. A lot of token holders today, and they own cryptocurrency, they don't really know what to do with it. They would like to use it as collateral to purchase real estate, for example. So you did something really spectacular recently with a transaction in Hawaii. Can you tell us?
Absolutely. And I think crypto holders know what to do with their crypto right now, and it is to hold.
Right, for sure.
They don't
Don't
want
wanna sell.
to. At this point, with the crypto-friendly administration, nobody wants to sell their Bitcoin. But as we talked with our advisor Michael Casey from CoinDesk recently, Michael Saylor, the MicroStrategy now strategy president, chairman, and founder. Bitcoin is the ultimate pristine collateral. You don't want to sell it. Yet the new generation, surprisingly, they love two assets the most. It's crypto, because it's fun, it's appreciating, and it's real estate.
The new generation
Real
is
estate,
that
yes.
new generation.
So with millennials, it was number 1 or 2. Now with the new generation, it's number 2 after cryptocurrency. So we want to see those two assets, very important assets, to be swappable, and both of them to be leveraged against each other. So for the first time ever, a week ago, we did a Bitcoin collateral loan for a real estate sale on chain. And everything happened on smart contracts. So a Bitcoin holder put their Bitcoin in our smart contract to get an instant loan, which the person got a USDC as a loan, bid on a property again, the smart contract. There were 3 bids.
Excuse me,
And
what was the loan to value to the Bitcoin?
So the property, the asking price was $250,000. So the bidders, if they want to get a loan, they have to put $250,000
The value of the
worth of
property?
Bitcoin.
Okay.
Yes, the same value as a property, or the same value as what they want to buy it for.
Okay.
So they put this Bitcoin into a smart contract, and if they don't win, they would get the Bitcoin right away back.
Okay.
If they win, we give them a loan, which is $250,000 in USDC, and then we settle entirely in a decentralized and a trustless manner. Smart contract settle the whole process. The owner, the current owner, the seller, receives USDC, and they don't have to deal with Bitcoin and selling and exchanging. And then the buyer gets the property.
So you lend USDC, you pay the owner with the USDC, you give a 1-to-1 ratio for paying the property. What if the Bitcoin goes down?
That's a great question. So this deal has double collateral.
Okay.
So we, as a lender, are very protected. And until Bitcoin drops to 50% price, we will not do a margin call.
So
So if it goes to,
50%
yes.
margin call. Okay, very interesting. Thank you so much. So now, talking about the regulation, what, in your opinion, and maybe Darren, if you want to touch on that, what would be the next wave of regulation that needs to happen in your field, but maybe broaderly in the crypto market for attaining a mass adoption?
So I think the first step is the CFTC's taking over oversight of the spot market of digital assets.
Okay.
And it does seem like the new administration is very much on the way to doing that. There's a piece of legislation called FIT21, which has passed through the House Financial Services Committee and has been approved by the House. That is essentially banking, so qualified custodians, that's what a bank is. And so qualified custodians have to hold it for U.S. persons, have to hold crypto.
So the banks now can custody crypto, right?
Correct. And so one of the things that you just mentioned, that dollar for dollar collateral that you're having, banks are able to use leverage.
Right.
Okay. And so, when you buy a home today, it's typically 20% down and 80% debt. Obviously, there's all different varieties of that in
Yes.
between. But in that sense, they're essentially providing you 80% debt. And so in this instance, again, collateral, like a Bitcoin, you can now use leverage for it. And so Reg T is 50% margin. Portfolio margin is a fluctuation of that, sometimes 80%, if not more. And so on the banking side, FIT21 will get that done. The other piece that we're excited about, because sitting between tariff policy, and this is just a fun fact, per unit of GDP, the U.S. is 3 times more efficient per carbon use than China, India, and Russia. And so when you look at tariffs, like what the EU has, it's called carbon border adjustment mechanism. It's basically for any import, you have to adjust for the price of carbon. And so because the US is 3 times more efficient, we would be able to bring in a lot of tariff dollars. And so there's a proposal from Republican Senator Cassidy out of Louisiana on the Prove It Act. That will tell you how much carbon it is. But all of these, digital asset on one side, tariff policy on the other, the thing that sits between that makes both those work really well is carbon.
No, interesting. Your take on that, Nick? Maybe what's regulation in your field, maybe in AEC field, what regulation could push the adoption of your technology?
Well, I'm anti-regulation.
Little
So it's, I don't know. I really, truly, I don't spend a lot of time thinking about regulation. For me, the true Web3 theology is what's going to help all this. Web3 wasn't created so a bunch of bankers can sit around and make money off people. It's to put the power back in the hands of the people. And so, from my perspective, I can't speak to everybody else's business models, but is open source technology giving people the tools to cut their time out, which is AI models, right? Is giving them the ability to monetize, and then giving them a seat at the table to participate in the storage as well, is what I see the future as. Because that's how you're going to get over the chasm, right? I mean, Web3, we're still talking to a very small group of people on a very important topic, and until you get mass adoption, we're gonna be stuck. And to do that, you have to give people things they can utilize. So.
And I will ask you, what would you say to your customers? And after, I will ask you for what you say to the asset managers for them to adopt your solution. So what, in your opinion, could trigger adoption from your customer to get more customer for your system?
Well, it's the more substantial ecosystem. So the more people that plug in with us, like as we integrate and other people integrate directly with us, right? We're going to HouseGov brings the market, like the AEC market, the people that are designing it, the 99.9% of the people that are actually making it happen. And so the more people we can get on board integrating, plug into our ecosystem, you have access to your customers, the future customers, things like that. And that's what's going to help drive adoption for everybody. Because if real estate, deals, you'll see them coming 2 years down the road. Same with digital twins, things like that.
Right. We see real estate is very slow to adapt to innovation, and asset managers, they have difficulties getting into the space. What would be your advice to asset managers if they are in the room, or if they listen to the panel after to adopt these technologies? Natalia?
Well, I think these events like today, when we give perspectives from different sectors in a huge real estate market, which is a $300 trillion or $400 trillion market today, it's very important just to learn and spread this knowledge amongst the executive team.
Yes.
With the asset managers. Definitely get into the crypto exposure just to kind of play around and test it out. But I think the regulation will be pro and more pro crypto infrastructure.
Yes.
And that would be the key. I used to be a real estate developer for 15 years, and I was dreaming about the day where we can transact real estate globally, cross-border, just like we take Uber anywhere in the world or take Airbnb. And these industries are highly regulated, yet they were able to get to mass adoption globally. And I was dreaming about sustainable urban development. I got a degree in Oxford because of this passion of how do we make less carbon footprint. And it doesn't matter if you believe in climate change or not. It's about energy efficiency at the end of the day. It's the consumers saving when they live in their homes. So now uniting this all together, having the data with Magma, where people are incentivized to put their renovations data, then having carbon footprint as an asset. I think just understanding those assets, how they operate, are very important for asset managers. But overall, I'm just very, very excited that it's all coming together today.
Right.
And with the regulation, the other point is that with Filecoin, as we store deeds on chain, and we actually had a pilot with Vermont County, where they stored all the deeds on chain, on IPFS with our technology. Now we get more and more requests from governments in other counties. And the main point here for those who don't understand this infrastructure conversation, why does it matter to have a decentralized storage? It matters because even if one of the startups don't survive, the data will be still there.
Right.
So whatever you store in Magma or in Triangle,
It's de-risked.
it's de-risked. It will stay there on chain forever, and that's the
Right,
essence
that
of
the
Web3.
immutability of the blockchain, the beauty of it. Maybe Porter, you want to touch
Yeah,
on that because that's really.
Well, I just kind of, I want to answer your previous questions, like, well, okay, if I'm an asset manager, what's the play here? And I think it's like, I think of a portfolio perspective, and I'll just use the 3 examples here again, is what, when you put them together, what does it really unlock?
Yes.
Now I got like a commercial, like I have a portfolio of commercial real estate assets. And like now I can have a single point of view on all my ownership through Propy as an example, where now my time to transaction, if I'm constantly flipping these buildings, I can shave off, pretty much 30 to 60 days off a close process than I currently do. So I have a lot more liquidity and mobility within my portfolio. Now if I'm looking at a portfolio level, I can also get more of a carbon sense of my portfolio from using something like Triangle. So now what does that say when I go out to the markets when I'm looking for loans where I can prove and adjudicate all my carbon claims across my entire portfolio? Does that give me reduction on interest rates and like showing what I can offset for carbon credits, because I have a track record and a history over time of how I manage carbon credits across my whole entire portfolio. Now let's say I use Hauschka for something where I put all my architectural designs in there and they're mine. Am I selling those designs to other real estate agents? Am I bringing in other designs so I can get to time to design faster and cheaper and more innovative? Because I'm using Gen AI based on architectural designs. And then how can I translate that into my digital twin? So again, it's going to help liquidity on ownership transfers, where now as I sell my building, I'm selling my twin. So I've de-risked it for the incoming buyer because now they have full visibility, verified on-chain of the whole entire history of the building. It makes me, as a commercial real estate owner of a portfolio, way more nimble, way more proactive and reactive depending on the situation. And ultimately what I'm trying to do is I'm trying to drive liquidity and value across every asset within my portfolio. And these things in aggregate give me a 3 to 4x advantage over the status quo alternatives for driving that liquidity and value enhancement.
Absolutely, that's a great conclusion. I think.
I mean, one more thing for driving adoption, just as a general note to Web3, is all this stuff that we're talking about and language we use, nobody else wants to hear that, right? And so to get more adoption, we have to put all this stuff in layman's terms. I mean, they don't want to hear it. They're normal people. They have a really hard time understanding what protocol is and on-chain. Just simply tell them how it's going to make their life better, and you'll get a lot better results.
It's all about what is the value you're bringing. You don't need Web3 to describe the value that you're bringing. Is how am I saving you money? How are you going to manage the risk of that asset? How are you going to improve the operations of that asset?
Absolutely. I think Porter described it pretty well. All the value added that all these solutions bring makes it an environment that is very fruitful for real estate and to make the necessary transition to the digital economy. Thank you everyone. Big round of applause, thank you.
All right. Group picture. Proof of work. Over here, right into the spotlight while you got it. Okay, ready to go. You're really making these guys look great now. Look at that. Okay, Ricky, Miami.